Saturday night, January 24th, 2026. While most people are doom-scrolling weekend headlines about a new Trump tariff warning, something else moved today. Something nobody will notice until the market forces them to, and by then, the price won't be the scary part. Here's the twist. The 100% Canada tariff headline may not be theater. It may be the spark that exposes a breakdown already building inside precious metals. If you want research-based breakdowns, dealer notes, shipping patterns, and the plumbing behind the price, hit like and subscribe right now. It helps this channel keep doing original work instead of chasing recycled clips. It also keeps this kind of analysis visible. Now rewind to what everyone saw. A threat of massive tariffs on Canada, framed as leverage if Canada deepens deals with China. Most people shrugged and thought, weekend drama. They figured by Monday it's old news. But the market's reaction didn't show up where people were staring. It showed up in Asia, in thin weekend conditions, where moves are supposed to be sleepy. Within about half an hour, silver popped hard in overnight trade. Not a slow climb, a sudden bid, like someone needed metal, not headlines. And here's why that matters. For weeks, physical silver in Shanghai has been printing meaningfully higher than the US benchmark. Call it a $10, $15 premium depending on the hour. That gap keeps refusing to close even when arbitrage should crush it. In a normal world, spreads like that get erased. Traders move metal, capture the difference, and global prices snap back into alignment. So when the gap hangs around, it's not vibes. It's a sign that the machine that keeps markets synchronized is starting to jam. Treat the spread like a stress gauge, not a bargain. The wider it stays, the more friction sits in the pipes. Now add the Canada variable, and the jam starts to make sense. Canada isn't only a neighbor, it's a key source of mined and refined metals feeding North America. Silver, gold, platinum group metals, inputs that matter for electronics, energy hardware, and industrial demand that doesn't care about narratives. If tariffs go from talk to policy, importing Canadian metal doesn't just get pricier. Planning gets impossible and trust evaporates mid-shipment. When trade policy looks unstable, insurers reprice risk and banks get cautious. A deal that looked fine on Friday can look unfinanceable on Saturday. That's how a political headline becomes a liquidity event. It doesn't need to be signed into law to change behavior. And when exposure shrinks, the market's smoothing layer disappears. Prices can jump because the cushion is gone. Because metal supply chains run on contracts, delivery schedules, and financing. They rely on confidence that the rules won't change between loading and customs. And that's where the second signal appears. A note circulating online, attributed to leadership at a major US bullion dealer. It describes wholesale conditions as chaotic, an industry circus. The reason isn't weak demand, it's tight credit and maxed out terms. This part is invisible to most investors. Between the mine and your screen price sits a middle layer that carries inventory so everyone else can buy smoothly. That middle layer is financed. Credit lines, payment terms, hedges, letters of credit, the plumbing that lets metal move without mountains of cash up front. When that plumbing freezes, the whole system coughs. Not gradually, suddenly, because nobody wants to be the last one holding risk with no funding. And that's how you get the paradox we're seeing. Demand is strong, prices are high, shortages are real, yet distributors hesitate to restock. Not because they hate profit, but because carrying inventory becomes dangerous when borrowing limits hit the ceiling and rules feel unstable. Now connect the dots. If Canadian supply becomes maybe expensive, maybe impossible for a chunk of US buyers, and wholesalers can't finance inventory like before, then arbitrage stops doing its job. The spread doesn't close because the pathway that closes it is clogged by cost, credit, and uncertainty. That's how you get Shanghai trading one reality and New York trading another. Not because one city is smarter, but because one region is securing the physical. Asia isn't only trading paper claims either. A huge slice of demand there is industrial. Electronics, solar, manufacturing, components that need metal on schedule. When those buyers need supply, they don't argue online. They pay up, lock shipments, and prioritize delivery over price perfection. So a stubborn Shanghai premium is a message. Someone is bidding for physical, and it's not easily leaving the region. Now, zoom out to gold because it adds fuel. Gold has been running hot, flirting with a psychological level that would drag mainstream attention in instantly. When that headline breaks, you don't get a gentle trickle of new buyers. You get a surge, and surges expose weak links fast. But what happens if the delivery system is already strained when the surge arrives? Premiums jump, fulfillment slows, and screen prices lag the real-world market. That's why the credit story matters more than the chart. Charts show emotion, credit shows capability, and capability is what delivers metal. Then comes the third signal, geopolitics. There were reports today about a US carrier strike group repositioning toward the Middle East. I'm not presenting that as confirmed fact. I'm saying markets price risk the moment it looks credible, long before official statements arrive. Because when funds model escalation risk, They also model supply chain disruption, currency stress, and inflation shocks. Those models don't point toward calm. So stack the weekend sequence, tariff risk, an already elevated physical premium, wholesale financing stress, and rising geopolitical uncertainty. That combination can flip a market from tight to dislocated in a hurry. And dislocation has a very specific look. It looks like regional prices drifting farther apart instead of converging. It looks like paper quotes that can't guarantee delivery at that quote. It looks like sudden gaps when electronic markets reopen because positioning was already happening while most people were offline. So here's what I'm watching when screens light up again. Not opinions, signals that can't be faked for long. Number 1, the Shanghai premium. If that gap widens after the reopen, it's decoupling behavior, not weekend noise. Number 2, the US wholesale bid. If dealers stop quoting size or premiums jump without warning, the credit squeeze is leaking downstream. Number 3, the reopen gap. If futures jump violently in a thin window, it usually means the smart positioning was placed before the story went viral. And there's one more piece that doesn't show up on a chart at all: storage behavior. Over the last few days, multiple storage providers have hinted at a sharp jump in serious vault inquiries. Private vaults, offshore storage, non-bank facilities. If that's accurate, it suggests bigger money is trying to secure space before liquidity returns. That's not what people do when they expect a quiet Monday. So ask yourself the uncomfortable question. If institutions are preparing for tight physical conditions, what do they think is coming at the reopen? Because in metals, price isn't the whole story. Availability is the story. And when it's questioned, psychology flips fast. What looks unexplainable is usually just the plumbing showing itself. That mechanism is what we're going to break down next. Here's the mechanism in plain language. Metals markets stay one global price only because the pipes stay open. The moment the pipes narrow, policy risk, financing stress, shipping friction, the global price splits into local prices. That's what a persistent Shanghai premium is screaming. It's the market telling you delivery in one place is more valuable than a quote elsewhere. And a tariff shock, even as a threat, can be enough to tighten pipes because it changes behavior before paperwork changes. Traders start pricing the risk that a shipment clears at a different cost than expected. Banks start tightening credit terms because the rules look unstable. Insurers reprice freight risk, and suddenly the easy arbitrage trade isn't easy. The spread can stay wide because moving metal becomes a headache. Now layer in the wholesale credit squeeze. Wholesalers are the shock absorbers of this ecosystem, and shock absorbers need financing to function. They buy, carry, and hedge inventory, so retail demand doesn't instantly break the system. If their credit is capped, the shock absorber turns into a brick wall. When that happens, demand doesn't disappear. It reroutes, concentrates, and starts bidding up the places where metal can actually be sourced. That's how you can see a screen price that looks calm while the physical market behind it gets tight. Screens can print, but screens can't ship. And once delivery becomes the main question, the market shifts from price discovery to availability discovery. So let's talk about the two outcomes that matter. Either prices converge violently or markets decouple, and regional pricing becomes the new normal. Convergence means the US price races higher to reduce the gap and pull supply back in. Decoupling means the gap can widen because supply can't move freely. If you're wondering which one is more dangerous, it's the one where everyone tries to adjust at the same time. That's when liquidity goes thin and gaps appear. Now add the gold factor. If gold pushes into a headline level that mainstream media can't ignore, new demand shows up fast, and it shows up all at once. People who never cared about metals will suddenly want exposure. Institutions that waited for confirmation will start allocating when the chart looks unstoppable. But if the physical distribution system is already strained, that demand hits a bottleneck. Bottlenecks don't create gentle moves, they create step changes. That's why the dealer note about wholesalers refusing certain products is so important. It's not a demand story, it's a financing and logistics story. Retail investors often think shortages begin at the coin shop. In reality, they begin upstream when the firms that bridge the chain can't fund inventory. Once that bridge weakens, it doesn't matter what the paper quote says. The local delivered price becomes king, and it can run far above the benchmark. Now let's address the weekend timing, because it's not random that these kinds of signals surface when most people are offline. And if reports about rising vault inquiries are even partly true, it adds a second layer: preparation. People don't seek storage because they feel relaxed. So what should you watch in the next reopen window? Again, not opinions, signals. Number 1, premium behavior. If retail premiums jump while the paper price barely moves, that's a warning that supply is tightening beneath the surface. Number 2, delivery language. If dealers shift from in-stock to pre-order to allocation, the pipeline is narrowing in real time. Number 3, regional gaps. If Shanghai stays elevated and other hubs start echoing it, that's the market admitting the global sink is weakening. Number 4, credit stress. When financing tightens, you'll see it as sudden limits, reduced product availability, and less willingness to quote a size. Now here's the part most people get wrong. They think a higher price solves a shortage automatically, like magic. Price helps, but only if the pipes are open and the financing exists to move metal through the chain. If credit is frozen, price can rise and nothing moves. That's when the paper market and the physical market talk past each other. One prints numbers, the other decides who actually gets delivered metal. And that's why this weekend's story matters even if the tariff never becomes policy. The threat alone can shatter confidence in tightened terms. Once confidence breaks, participants defend themselves. They shorten payment windows, increase collateral, reduce exposure, and hold what they can source. That behavior creates the very shortage everyone is afraid of, not because metal vanishes, but because circulation slows to a crawl. One more detail on why this can get weird. Silver isn't one identical object everywhere. Different bar sizes, refinery stamps, and delivery standards matter. A bar that clears easily in one hub can require reassay, remelting, or new paperwork in another. That adds time, cost, and financing needs. And that's how regional premiums can persist even when the internet says arbitrage will fix it. Arbitrage only works when the product is truly interchangeable. Tariff risk makes interchangeability worse because it adds a political price on top of a physical product. Nobody wants to be stuck holding metal that suddenly faces a new cost gate. Now look at paper pricing. Futures markets are efficient at netting claims and compressing exposure into a number, especially when most participants never demand delivery. But if more players decide delivery matters, the system has to ration metal. Rationing shows up as higher premiums, longer lead times, and tighter availability. So if you're tracking this like a pro, separate these two questions. What is the quote, and what is the delivered price where I am? Delivered price includes logistics, insurance, financing, and now policy uncertainty. When those add-ons expand, the headline spot number becomes less informative. If upstream can't fund it, you get allocation and limits, even in a rising market. That's the exact opposite of what most people expect. And the bottleneck is what we're testing at the reopen. If the pipes hold, spreads compress. If the pipes don't hold, spreads expand and premiums jump. So when markets reopen, don't just watch the headline candles. Watch the microsignals that tell you whether circulation is healthy or sick. If the spread narrows with stable premiums, the system is still absorbing stress. If the spread widens and premiums jump, the system is losing sink. And if geopolitical risk escalates at the same time, the demand side becomes less price sensitive. That's when moves can turn sharp and fast. I'm not telling you what to buy or sell. I'm telling you what the structure is signaling, because structure usually moves before the crowd does. Sunday night will print the first clues. Monday morning will tell you whether this was weekend noise or the start of a new pricing regime. Either way, the old assumption, one global price, smooth delivery, frictionless arbitrage, has been getting weaker. This weekend made that weakness visible. Keep your eyes on the premium, the credit language, and the availability cues. Those are the tells that can't be smoothed over by a talking head.